This is the Sunday, February 5th, 2023 new week opening gap. And the way you want to locate that is you want to go into a lower time frame chart. You don't want to use your daily chart because your daily chart is going to be using a settlement price that may not be in alignment with what we're showing you here to use. So you can use a 1 or 5 minute chart, and you're going to be using the Sunday's opening price, which will be represented here, and the closing price on the Friday prior. Okay, so there's a difference between those two price points. Okay, so it's the open on Sunday and the close on the previous week's Friday. Midpoint here, which is consequent encroachment. The week after that, next Sunday, would be Sunday, February 12th, 2023. And this is the new week opening gap for it. And here's the closing price on that Friday. Then the opening price on Sunday, and the midpoint here, which is consequent encroachment, the difference between the two. Now, the ICT new week opening gap is a tool that I utilize to give me large fund fair value, meaning that the markets will generally gyrate on a little bit higher time frame, pulling back to old new week opening gap. It's kind of like when an inefficiency is filled in and repriced to. The algorithms refer to old inefficiencies and old liquidity voids. Now, a real liquidity void is an absence of any buying and selling. There's no printed data between two specific price points. And I like to have a minimum of 5 weeks worth of it. But you want to have at least 4, minimum 4 new week opening gaps on your chart for proper perspective of large fund fair valuation. I like to have 5 because it keeps a dynamic full month's perspective. So that way it kind of gives you a little bit of an overlap, not just the blanket 4 weeks look back. So we're using the closing price on Friday, the opening price on Sunday. So those 2 price points there's a difference. Even though we see it trade back up to it here, from the open, trade right back up to it, that's normal. You expect to see that. But once it does that, we don't ignore this gap. So I like to use new week opening gaps that are split into quarters, but I don't need to have the lines there. So whenever I see the midpoint and the high, I can roughly see the midpoint here without having a line on it. Now, once you have this and you lay it across your chart, you can see how price refers back to those old new week opening gaps. And they many times are treated as support and resistance. By having at least 4, preferably 5, it gives you a rolling 30 days or month look back. Now, there's no real limit as to how many you want to keep on your chart, but I think this is an optimal level here. So we can see what's being referred to and how the market can gyrate back to real fund level valuation for fair value. So it's not just simply a matter of a fair value gap, but we use the new week opening gaps like fair value. This vertical line here delineates the gap for that particular week. You can see how we've acted as resistance here, consolidated around until here, found some support, trade through it. And then the new week here, because this one here is that new week opening gap for this particular week going from this date to the right. Look at how price is respecting consequent encroachment of that new week opening gap. And again here, the high and consequent encroachment rejects it, then trades back down into the new week opening gap of this particular week. It leaves it. We start a new week opening gap here, and look what happens. The market moves away aggressively. So we have a trending day, trending week, where we move away from the new week opening gap. So when we're close to the new week opening gap, we're in range bound. If it has a difficulty moving away, keeps coming back to it, we're in consolidation. Range expansion or trending is when we leave the new week opening gap and don't return back to it. You can see we have a nice weekly trend model there. The new week here, you see how we traded into it here, support, whipped around resistance, moved lower, came back up, support, rallied. New week opening gap here, and we gravitate back to an old new week opening gap here, and then finally back down into a previous week's new week opening gap as support. You can see how price will many times gravitate back to it or a previous week or week's old new week opening gaps. So it's not just like we used this week's and we're done. It's important to have that data on your chart and keep it as a template. Your homework assignment is to use the opening price on Monday at 9:30 for ES and use the Friday closing price at 4:59. That is another new week opening gap. You're not factoring in Sunday's trading at all. So there's 2 approaches to using new week opening gap. Actual is the actual opening on Sunday because there's trading going on there. We have new week opening gap actual where it's Friday's close price to Sunday's opening price. Then we have new week opening gap, which is simply what? Friday's closing price at 4:59 and 9:30 opening price on Monday. Having those 2, you're going to have 2 templates now. You're going to be able to see different new week opening gaps and how fair valuation is utilized throughout the week and weeks and across a spectrum of at least a month or so.